Thanks so much for tuning into this conversation. The earnings season is gone by, and we're trying to talk to companies who we didn't talk to post their quarter one, but we did something very interesting in the quarter one, either in the quarter or in terms of the guidance or in terms of the commentary that they gave about the longer term. Now, in Kaynes Technologies case, in a seasonally weak quarter, they delivered a strong performance, and the management commentary also was positive, which is why we thought it'll be lovely to talk to Mr. Jairam Sampath. He's whole-time director and CFO of Kaynes, joins us right now on the show. Mr. Sampath, thanks for taking the time out. Really appreciate you being with us. At the onset, Mr. Sampath, for the uninitiated, very briefly, what is Kaynes doing currently, and what kind of company do you think Kaynes will evolve into over the course of the next couple of years?
Yeah. So thank you for having me on this show. See, primarily we are a player in the ESDM sector, electronic system design and manufacturing. And we started off about 3 decades ago. And today we have come to a situation in which we can do most of the complex electronics, etc. We operate primarily in the low to medium batch sizes and high complexity, high criticality products. And we are expecting this sector to grow too. And I think for last 2-3 years, we've reached a tipping point in the country in terms of import substitution and so on. So we are having a huge amount of business which is facing us, companies which are into this space. And going forward, we would become a company which is not only in the ESDM sector. We would also like to, as we have mentioned in our prospectus too, we'd like to examine and explore backward integration to other areas like the bare PCB manufacture and semiconductor, etc. So I think we are ahead. We look forward to exciting times ahead with this entire focus on Atmanirbhar Bharat by the government also, which has qualitatively changed the direction for most companies like us, wherein we are now focusing not for the rest of the world business, but for the business of manufacturing for Indians. And so that is going to be the first stage of growth. And you can see explosive growths going over the next few, let's say, like next several years, maybe more than a decade or so. And I dare say that manufacturing in electronics will be the flag bearer of resurgence of manufacturing within the country. As you know, we are primarily services and agri-oriented economies. And one of the main things that will propel our income also will be having good share in manufacturing. And I'm happy to say that we are an industry which probably will be the flag bearer of this resurgence of manufacturing in the country.
Got it. Again, before I talk about the strong quarter one, just a quick understanding. Now, let's assume that the landscape is very, very strong as you enumerated already. So, Mr. Sampath, in such a scenario, how does Kaynes evolve? You are a company which is about 80-20 domestic export. I mean, 1% or 2 here and there, but broadly those numbers. You are a company which probably looks at about a 15% EBITDA margin profile currently. And I'm guessing that you would want to move along that, select return ratios as the case may be. How do you think it evolves over the course of the next few days, or rather next few quarters, or maybe the next 2-3 years?
Yeah. So essentially we are present in 6 sectors, which is automotive, industrial, and electric vehicles. Then we have railway signaling, which are 3 primary sectors contributing about 75% of business. And then other 3 sectors like medical electronics, strategic aerospace and outer space, and IT and IoT. So they bring up the remaining 25%. And each of these sectors are fired up very well today. And so we currently, broadly, what we say is our gross margins are around 30%, and we do an EBITDA of about 15%. And at net level, quarterly profiles might change, but we are saying that about 9 to 10% of PAT will be there at the end of the year. And we don't think that this profile will deteriorate anymore. If at all anything, due to scale economies, we might do a tad better in the coming years. This year, we have set about 1,700 crores as the guidance for this year. Maybe it will go to about 1,800 crores in terms of business. And we have a strong order book. So obviously, that is also going to push our revenues along in a strong way. We have an order book of about 3,000 crores at the beginning of July. So going forward for the next year, already out of this, even if we do as per whatever we have planned, about 1,500 of these will have to be probably considered for the next year. So we are looking forward to a good growth in the next year too. And on a CAGR basis, anywhere between 30 to 50% growth you can expect in this kind of scenario. And it's our estimation that qualitatively these are all, let's say, quote unquote, organic kind of growths, existing type of products and existing customers and so on. And on top of this, there are also certain what we call new clients that we are working. And obviously, as and when we finalize with those, we will probably announce it. So that is also likely to add to the bullishness of our revenues.
So, sorry, are you saying that you believe 30 to 50% CAGR for what period? Of course, part one, and part two, what length of time is I mean? And part two of my question, when you say new clients, you mean inorganic growth, which might add a layer of growth to this 30 to 50% number that you're talking about?
Yeah, when I say it's not inorganic as an acquisition, but it's newer clients which are not part of my order book. See, order book contains
as of now, okay.
Existing clients. Yes. And when we say CAGR of 30 to 50%, it can be over extended period of time. Of course, I don't want to hazard a guess as to how many years, but certainly in the near term, 3 to 5 years time, this kind of growth is not unlikely. So obviously, we have to take one quarter at a time and so on. But in our business, I think we have reached a stage in which this quarterly, let's say, unpredictability will be less in our kind of business.
Why so? Why so, Mr. Sampath? Why do you say so?
Yeah, because, for instance, if you notice, we have an order book of about 3,000 crores. So nothing majorly will happen in the one quarter to dim our quarterly numbers, actually speaking. Having said that, obviously, we can't tempt the fate in the sense that we can't say, we are doing this, etc. It's always into the future. But broadly, whatever guidance we give, I think should happen because it is on the back of orders that we have registered in our system and we have made arrangements for materials, etc. So, if you notice, about 2-3 years ago, our order book was just 400 crores or so. That represented just maybe 1 year's worth of orders, but then the yearly number was less. Today, it represents 1.5 years worth of orders, and it is at 3,000 crores. And this is sustained over last several quarters. If you say about last 16 quarters, we've been having quarter-on-quarter increase in the order inflow. Currently, order inflow for last quarter, quarter of April, May, and June of 23, has been 216 crores per month. So, this is also kind of going up and giving let's say, a run rate which is buoyantly up. So that's why I say that this quarterly number unpredictability will be lower in our kind of business right now. So we are sitting on top of order books and also sitting on top of some bullishness.
Got it. Mr. Sampath, a lot of times people look at what a company has gone through in the preceding 2, 3, 4 years and then think that maybe the best is behind. Now, when you guys within yourselves sit in your boardrooms and talk about what is the industry scenario looking like, what are customers telling you, what are policies pointing towards, what are global opportunities looking like, do you feel that the best is yet to come?
Yeah, in fact, I would even say, even if it's a little cliched, the better is yet to come and best is still far away. Because of the sheer volume of imports that country has been doing, huge amount of imports in our business has been being done. Obviously, earlier, logistically and capability-wise and capacity-wise, the companies here are not capable of turning around those electronics manufacturing in India. But going forward, especially in the industrial part, quote-unquote industrial part, which is like low to medium volume and high mix and high-tech parts, huge amount of capabilities now exist. And there are many, not only us, but peer group companies who can shoulder the burden. See, and just doing electronic manufacturing for the country itself. You mentioned 20% export and 80% domestic. We may not improve on the percentage of exports because the sheer pull from the domestic manufacturing itself. But going forward, on the back of this development of domestic manufacturing, we'll also become a globally good supplier. When I say globally good, we'll have the technology, we'll have the scale, and obviously we will be able to give the kind of quality that global people require in this field.
Is there a
better is yet to come?
Sorry, is there a seat in the table that you're missing currently as well, which will come to you maybe with growth that you foresee over the next couple of years? Could that happen?
Very much, very much. At this point in time, we are focused on completing the, let's say, momentum which is forcing us to do all the import substitution and all that. Added to it, there is this concept called China Plus One, which none of us have seen yet translate into our order book or numbers yet, and that is going to add the next, shall I say, accelerator. And for that to happen, India also has to graduate into a, like I said, seat at the global table of electronics manufacturing. And we do understand that there will be players. See, government is also pushing a lot of domestic manufacturing. So obviously, they are probably asking the global majors, maybe other than Chinese companies, to come into India and even do FDI and set up companies. So we expect that on the back of these policies and all this current momentum, a lot of other capacities will be kept put into India. So India will become a focus of attention. So it's much like some of these markets, no? You go to certain markets for certain products, right? Because they get well known for those kinds of activities. So India, so earlier people used to have the habit of going to some city in China, say Shanghai or something, and then they used to do all this sourcing. So they never came to India and asked what is the price and what you can do. So buying is a habit, and hopefully another 2-3 years time, in this habit, India also will be a destination where global purchasers will come here and then look for people. By that time, I would imagine they will have choices in India. Maybe companies like us, maybe several companies like us, whom they can depend on to supply their complex electronics needs. And also logistically, some of the product assemblies have to happen in India if the electronics has to be locally sourced. And these, of course, are in the high-tech areas and so on. So I am not assuming that we will immediately get all of this just because we are importing this and immediately government wants to do it. There's also this capability building exercise that has to go on. While electronic assemblies, we are there, but in terms of product assemblies of high-tech products, still some more distance to go. But I'm quite happy to tell you that we are in the right direction. India has all the capability and competency to do it. Capacity building is yet to happen, but capitalization has happened. Many players like us have listed now, 4 or 5. So just to tell you honestly, a listing gives you the kind of unlimited treasury, quote unquote. You know why? Because if you can bring a project which is yielding good returns, etc., then you can fund it because you're listed. You can always raise funds and so on. Earlier, it was not so. So you can see an acceleration in terms of capacity building, acceleration in terms of quality of work that is happening and so on, and acceleration in terms of ecosystem development. So there are a lot of other aspects to this, just not merely assemblies and so on. Sure. You need to have silicon assemblies. You need to have other products to be assembled and so on.
Got it. Mr. Sampath, I heard you say that you haven't experienced the China Plus One moment as yet. You reckon by virtue of client conversations that it is in the offing, or is it for now a hope trade? A strong hope, but a hope trade still.
No, it is, okay, let me put it this way. So there's the initial excitement stage, right? So we are past that excitement stage. Now people are contending with the realities of a transfer of business from China. Obviously, this always hinges on how countries like US behave with China as a country, right? So political situations in the US and their nature of relationship with Chinese will determine how the global companies view this whole China Plus One strategy. Having said all of that, it looks like Americans have hardened their stance in terms of at least high-tech manufacturing. They certainly don't want to invest more into China. Their FDI inflows into China have come down, and I think last quarter Chinese also there have been some deflation and so on. So all this points to the fact that China Plus One now is in the crucial phase of finalization, and it may not happen as fast as we think it will happen, but certainly it will happen for sure.
Do you hear from your clients about it?
We have some client conversations, at least a couple of them, wherein they want to shift. So in the beginning, they were saying 6 months we will shift. Then they obviously went back to Chinese government and said, can we transfer assets? They say, no, you can't. Then they have to redo the strategy because already some investments have been done in China. So they kind of look for, let's say, one set of products, we'll do it here and so on. So there is an interim period where also if all of that business comes in, we are also not ready to do it. So there's an interim period where partially, so let's say China plus 0.5 and then China plus 1 will happen going forward, which is good for us. I think I just want to say as a concept, without China, you cannot do electronics, even in the future, ever. Because China is a strong player. They do a lot of commodity components and so on. They have got a lot of capacities built. And so obviously, what we are saying is Chinese can do what they do well, and we should do what we do well. That is complex assemblies, testing, and so on. So we want only a fair share of the market. We don't want all of it.
Yeah, a point well taken. Last couple of questions. One, you moved from a book to bill ratio which was not as strong maybe to a book to bill ratio which is probably 1.5 times, or your annual revenue, if you will. Do you reckon there is a possibility for the space at large, and maybe for you, for book to bill ratios to be even higher than what they are right now, even with the higher annual revenue numbers that you will clock in over the course of the next 2-3 years?
Yeah, it's a very, very good question, actually. So this has to be explained from the heart of business that we are doing. So when would a client give you an order for more than 2 years? Only when they have got a project which is going to fructify after 2 years. It has got complexities, and that's why he's giving you an order. If it's a simple product, then they may probably not give you that order. So we expect that these order books will definitely, book to bill ratio will increase till such time. And they may stabilize at a large number. So typically what will happen is all these electronics that we are now manufacturing, these typically, I won't be surprised if companies carry 2.5 years worth of orders on their books. And that's when it will be also very profitable. See, what happens is that when a company gets an order for, let's say, 2 years hence, then they can order components on the basis of lead times, which the pricing is much lower than when they order materials on a shorter time cycle, which is when they have to pay premiums. So it's very important that this book to bill ratio improves, so that profitability also will be better. Same business, if I don't have orders and if I have to execute them in 6-month time frame, then my profitability is much, much lower. And that also probably tells you the difference between some of the industrial products where there's a longer horizon of orders compared to non-industrial products where there is a shorter horizon of products. Of course, there are other differences too. It's not the only thing.
Yeah. So you reckon that there's a possibility, Mr. Sampath, that operational metrics,
100%.
return ratios, etc., could actually inch higher over the course of the next 2-3 years? Everything else working to your plan?
Yes. So obviously, what happens in next 4-5 years, because of the sheer momentum of business, all metrics will improve. Whether working capital, whether you talk about returns and all that, because demand outstrips supply. Okay, so obviously metrics will improve. But then, like any other S curve, once it flattens out, maybe after 10-15 years, those companies which have developed over the time good systems and procedures and make sure that they can retain those gains will retain. Others may see some problems. Right now demand is driving, nothing can go wrong. But after 10 years, if you will ask me, when companies become $1 billion or whatever number that faces us, at that point in time, companies with good systems, good procedures, and people who have taken right decisions now, they are the ones who are continuing to probably perform at that time.
Okay, I'm guessing when you say the number that faces you, you're talking about revenues moving up from 1,800 crores to whatever number that you spoke about in the next 3 to 5 years, ballpark.
I wouldn't give a number, but as soon as possible.
I don't want to put a number into your mouth. Sorry. I don't want to force a number into you. Great.
No. We have an ambition of being $1 billion company, but when exactly it will happen will be determined by how well we perform and how the markets
Most
go.
certainly. But I did hear you say.
Yes.
But I did hear you say that you believe that you would be able to continuing this number 30 to 50% growth without inorganic moves in the foreseeable future.
Yes.
Okay,
yes, that is true.
Got it. One last question. Are you eyeing inorganic growth as well? You have some cash in the books. Would it be used only for capex, or could it also be used for inorganic moves?
So right now the cash in the book is objects of the offer where we have not talked about any inorganic growth.
Okay.
Having said that, we do have some 100 odd crores for general corporate purposes, can be used for acquisitions, etc. But right now we are not contemplating using any of these things because existing business demands capacity. But going into future, maybe other geographies like US and other places, we may look for some small acquisitions just to give us a foothold And so that's a discussion we can do probably a little later once we become, let's say, prepared with all the details and so on. But it is on the anvil, but not out of the funds that we have right.
But you won't need to do any fundraise for financing capex or acquisitions in the near term, or would you?
Okay, I would qualify that. On the existing part of the business, I think this will stand us in good stead, and this will become a self-funding kind of an exercise, given this kind of growth and cash generation over next several years. But any new projects that come up, as and when they do come up, we will certainly come back with information about the same. And if they are different from this business, then obviously we can access markets for funding as required.
Are you
this
eyeing,
is as far as the ESDM business.
Are you eyeing newer businesses?
We have already said in our prospectus too that we will do backward integration into bare PCB.
So for that you might need fundraising.
Yes, certainly.
Okay, great. Mr. Sampath, it was lovely talking to you. I extended the time for a minute because the conversation got very interesting. So thank you for that. And thank you for taking the time out.
Thank you, Neeraj. Always a pleasure. Thank you.
Thank you. And viewers, thanks for tuning into this earnings conversation. Actually, it was not as much an earnings conversation as a lot more with Kaynes Technology.